So hello all my dearest students of South India. I hope you all are doing good. So today we are going to revise the chapter, one of the most important topic in your CA final direct tax and international tax, and that is transfer pricing. Okay. Along with transfer pricing, we'll also try to revise certain other small topics also which are important like DTAA, like business trust, so on and so forth. Okay. So let us start without wasting any further time. The first thing that we need to understand in this chapter is the chargeability of transfer pricing. When transfer pricing is applicable if there is an international transaction and out of that international transaction you are earning some income, then you have to compute the income as per the arm's length price. Now, what does income include? Income will include only sales or revenue? No. Income will include sales also, income will include revenue also, income will include gross receipts also, income will include your expenses also, income will include your interest cost also, and many other aspects. Okay. Now, what is international transaction? That is defined in section 92B. That we'll see after some time. What is arm's length price? That is defined under section 92C. That also we'll see after some time. Don't worry. Okay. Now, apart from that income, apart from expense, apart from cost, transfer pricing is also applicable if there is some transaction between two or more associate enterprise and they are trying to allocate some cost between themselves or apportion some cost between themselves. Then allocation of cost and apportionment of cost should also be done as per what? As per the arm's length price. Okay. Plus, transfer pricing is not only applicable on international transactions, but it is also applicable on certain domestic transactions. Not all domestic transactions, but certain domestic transactions also transfer pricing provisions are applicable. Okay. Last but not least over here, transfer pricing is not applicable in certain cases. Transfer pricing is not applicable if there is a reduction of income or if there is an increase in loss. It means if it is detrimental to the department, then transfer pricing is not applicable. For example, if you are showing your revenue as 2000 rupees, but if the arm's length price says that no, the revenue is not 2000, it is 1500, then it is detrimental to the department because that will reduce the profit. And if it is reducing the profit, that will reduce the taxes for the government, then transfer pricing provisions are not applicable. Okay. Transfer pricing provisions are not applicable if there is a reduction of income or if there is an increase in loss. It means transfer pricing provision cannot be beneficial to the assessee. It will always be beneficial to the department. Okay. Now, the first thing that we need to understand over here is transfer pricing is always applicable if the transaction is between associated enterprise. So, what do you mean by the term associated enterprise? It is defined in 92A and we have to see one by one what all things comes under the definition of associate enterprise. The first thing that comes is one entity holds 26% or more of the equity shares of the other entity at any time during the previous year, then both of them are deemed to be associate enterprise. If I hold 26% of the equity shares in your company for any time during the previous year, then we both are deemed to be associate enterprise. Second case, there are around 10-11 cases over here. Second case, when one entity holds 26% of the equity in one entity and 26% of the equity in another entity, then these two entities are also considered to be what? These two entities are also considered to be what? As associate enterprise. Check it please. Third one, when one entity's total book value of asset is 100 rupees and at least 51% of the total book value of asset is financed by the other entity. I have a book value of asset of 100 crore and you are financing me 51 crore rupees at least out of it, then we both are also deemed to be associate enterprise. Next, if I have a total borrowing of 200 lakhs and you guarantee me at least 10% of that, 10% or more of that is the guarantor, which is you, and therefore I and you will be considered to be deemed to be associate enterprise. See, there are various varieties of associate enterprise over here. I am just borrowing. I am borrowing and you are guaranteeing just 10% of my total borrowing. Then also we both are deemed to be associate enterprise. Next one is a point in which there are three multiple points. 1, 2, 3. Let me explain you. Suppose there are two companies, 1 and 2. A Limited, B Limited. If A Limited appoints more than half of the directors of the B Limited, then we both are deemed to be associate enterprise. Or if A Limited appoints more than half of the members of the governing board, then A Limited and B Limited are deemed to be associated. This is first point. If A Limited appoints just one executive director of the other company, B Limited, then we both are also deemed to be associated enterprise. If A Limited appoints just one executive member of the other company, then also we both are deemed to be associate enterprise. This is what it is written in point number 5. Okay, let's come to point number 6 now. Unilever USA. Now, point number 6 is a continuation of point number 5 only. Suppose I am one company and there are two companies over here. A Limited and then in front of me there is B Limited and there is C Limited. And if, for example, of B Limited I appoint more than half of the director and of C Limited also I appoint more than half of the director, then B or C are deemed to be associated. Suppose if I appoint one executive director of B and one executive director of C, then B and C are also deemed to be associate enterprise. So all the combinations which I have told you in the previous example will work over here also for B and C, and B and C will be deemed to be associate enterprise. If I appoint one executive member of the governing board of a B B and one executive member of governing board of C, then B and C are also deemed to be associate enterprise. All those permutation combinations will work over here. Next. I am in India and there is a company outside India and I am dependent on that company for the know-how of that company, for the patent of that company, copyright of that company, the trademark of that company, license of that company, franchise of that company, and I am wholly dependent on all these things of that company, then myself and that company is also deemed to be what? Associate enterprise. Be very careful. Then I and that company, if one company is dependent, if one enterprise is dependent on the other enterprise for wholly dependent on technical know-how, patent, copyright, trademark, license, franchise, then both of them are deemed to be associate enterprise. Next. I have purchased total raw material of 100 lakhs. And if I purchase 90% of the raw material from one company only, then I and that company will become deemed to be associate enterprise. I have total 100 lakhs raw material purchase. If 90% of the raw material is purchased from one company, when we both are deemed to be associate enterprise. Next one is for individual. One entity is controlled by individual and another partnership firm is controlled by individual and is relative. So then both of them are deemed to be associate entity. One entity is a sole proprietor. Another entity is a partnership firm which is controlled by me and my wife only. Then we both are also deemed to be associate enterprise. One entity is HUF. And another entity is in the form of any other entity which is controlled by whom? Which is controlled by HUF or its relatives. Then myself and that enterprise will also be deemed to be what? Associated enterprise. So I am an HUF and there is one entity outside India which is also controlled by me or the member of my relative or the member of my HUF or the relatives of the HUF. Then myself and that particular enterprise will also be deemed to be associate enterprise. Last but not least, I am a partnership firm AOP BOI. I am partnership firm AOP BOI and there is some entity who holds at least 10% in my firm. Then we both are also deemed to be associate enterprise. Check it please. So these are 11 different cases of the definition of associate enterprise. Now to make a transaction covered under transfer pricing, the transaction has to be what? International transaction also, and therefore there are two subsections of international transaction. One is a normal international transaction, another is deemed international transaction. Let's talk about the normal international transaction first. When a transaction will become a normal international transaction, when it is entered between two associate enterprise, and one of them have to be non-resident. Can both be non-resident? Yes, both can also be non-resident. Can both be resident? Both resident, not possible. One of them have to be non-resident and the transaction has to be between two associate enterprise. If a transaction is between two associate enterprise and one of them is non-resident, then it can be called as what? International transaction. And then the nature of transaction can be anything. It can be purchase, it can be sale, it can be borrowing, it can be lending, it can be business structure, it can be leasing, it can be provision of service, etc., etc., etc. It can be of any nature, it doesn't matter. Okay. Next. Then what is deemed international transaction? In deemed international transaction, what happens? This is X, this is Y. Both of them are associate enterprise, but you do not directly deal with your associate enterprise. You deal with what? You deal with a third party. You do transaction with a third party and third party has a transaction with your associate enterprise and there is a prior agreement between both of them. So you do not directly deal with your associate enterprise. You deal with a third party and third party has a prior agreement with what? With your associate enterprise. So if you do a transaction with a third party and third party already has an agreement with your what? Associate enterprise, then the transaction between you and this third party is deemed to be international transaction. In that case, this third party can be anyone. Even if this third party is a resident, then also it is deemed to be international transaction. And if this third party is non-resident, then also it is deemed to be international transaction. The residential status of third party does not matter over here. Irrespective of the residential status of the third party, it will be deemed to be international transaction. Check it please. So now let's talk about computation of arm's length price. Who will compute the arm's length price first? It will be computed by the assessee. How will they compute? They will compute as per the most appropriate method. First, assessee will compute as per the most appropriate method. Okay. How will they come to know what is the most appropriate method? They will come to know by the nature of transaction, by the class of transaction, by the functions performed by the assessee, by the risk assumed by the assessee. So all these factors, they have to keep it in mind and they have to check which method is best. How many methods are there? These are the 6 methods which you can see in front of you. We'll be talking about all of them one by one in a while. Okay. Now, is it necessary that once the assessee has computed the arm's length price that nobody is going to question that? Definitely the assessing officer will question that during the assessment. During the assessment, if assessing officer at the time of pendency of the assessment, if he has material or information in his evidence and if he finds that any of the 4 things are happening, then he will raise a question on the arm's length price and he will send you a show cause notice. So once you have computed the arm's length price, don't be under an impression that nobody is going to check that. Obviously, the assessing officer will check that during the assessment. So when he will check that, when he will say that the arm's length price, I disregard the arm's length price, if he feels that, if he is of the opinion that the price charged or paid is not as per this section, the price charged or paid is not as per this section, if he is of opinion that the price charged and paid by the assessee is not as per this section, he will issue a show cause notice to you. Or if he has opinion that you have not kept the relevant documents which you have to keep as per section 92D, or if he has the information that, if he has opinion that the data which you have collected for computation of arm's length price is not reliable or it is not correct, it is not reliable data, it is not a correct data, so he can compute the arm's length price at his end. Or if he has the opinion that he has asked the information from the assessee and assessee has failed to reply the information within the time specified under 92D, if any of the four things are happening, then he will send you a show cause notice. After giving an opportunity of being heard, he will determine what? He will determine the arm's length price. Now, when he determines the arm's length price, be very careful. And if he increases your income, okay, so suppose earlier your total income was 360 lakhs. Now, if he increases the income to 300 suppose earlier your income was 300 lakhs. Now, if he increases your income to 360 lakhs, so this 60 lakhs which is increasing now, on this 60 lakh rupees, you are not going to get what? First of all, on this 60 lakh rupees, you are liable to pay penalty, interest, tax, plus on this 60 lakh rupees, be very careful. There are 2 points which I would like to say. On this 60 lakh rupees, you are not going to get any deduction under chapter 6A or on 10AA. Your deduction will remain at 300 lakhs only. Earlier, your income was 300 lakhs. So the AO increased the income by 60 lakhs. So you are claiming deduction of 300 lakhs. Now, because the AO is increasing the income by 60 lakhs, on this 60 lakh rupees, you are not going to get any deduction under chapter 6A and 10AA. Further, on this 60 lakh rupees which is increasing, earlier I was paying to my associate enterprise 100 lakhs. So I deducted TDS as per 100 lakhs at 10%. Now the AO has reduced my arm's length price from 100 lakhs to 40 lakhs because he has reduced by 60 lakhs. Okay. So now if I am showing my arm's length price as 40 lakhs, the other person, my associate enterprise, cannot recompute his income and claim the refund. Be very careful. Earlier I was paying how much? 100 lakhs. So I deducted TDS at the rate of 10%. So the other person was also showing income as 100 lakhs. But now the AO is saying, no, your expense is not 100, your expense is only 40 lakhs. Now this person cannot recompute income and take what? Refund. This is what it is written over here. Check it, please. This is what it is. These are the 2 points which are extremely important for exam. ICAI has been testing these 2 points again and again in the exam. Okay. Now let's talk about certain methods which are there under the arm's length price. Now it is very difficult to explain the methods without the help of the example, but still I'll try my best to explain to the steps which are relevant over here. Okay. Now comparable uncontrolled price method. What happens in this method? There are 2 transactions. One is with the associate enterprise, one is with the third party. So the one which you are doing with the associate enterprise, that is a controlled transaction, and one which you are doing with the third party, that is an uncontrolled transaction. So how to compute arm's length price over here? First of all, find out the transaction price with the uncontrolled transaction. So uncontrolled transaction, purchase price, sales price, whatever is there, that will become your step number 1. Okay. Then see the functional difference between the two, between your international transaction and between your uncontrolled transaction. Find out the functional difference. There might be many functional differences, like there is a warranty over here, there is no warranty over here, there is a discount over here, there is no discount over here, so on. There is a freight and insurance over here, there is no freight and insurance over here. So you have to make an adjustment, addition and deletion of those particular adjustment. That is a pure application of logic. Okay. And after that you will get your arm's length price. Okay. For that you can go and refer your question bank, and there are some questions based on that in the question bank. Okay. Resale price method, what happens? In resale price method, what happens? First of all, let me give you a background. You purchase some goods from your associate enterprise and then you sell to third party. Okay. You purchase some goods from associate enterprise and then you sell to third party. At the same time, you also purchase some goods from unassociated enterprise, that is unrelated party, and you sell to unrelated party. So there are 2 transactions. One you are purchasing from your associate entity, selling to third party. One you are purchasing from third party and selling to third party. So what is step 1? The step 1 is the price at which you have purchased from associate enterprise and then you resold to your third party. Purchased from associate enterprise at 2,000 rupees and resold to associate enterprise at 3,000 rupees. So that 3,000 rupees will become your first step. The price at which it is resold to third party, purchased from associated and resold to third party, that will become your step number 1. Then the GP margin which you have purchased from unassociated and sold to unassociated, that GP margin will be reduced from here, Third, if you are purchasing from associate enterprise, you might have incurred some purchase related expense like freight, like custom duty, then you reduce that also from your cost. Okay, then you see the functional differences between the two, then you reduce functional differences between the two, and after that you will get what? Your arm's length price. Check it please. So let's go ahead with the next method, that is profit split method. Now when this method is applicable, when 3-4 companies come together for a joint venture. Okay, so when they come for a joint venture, first of all you have to find out their combined net profit. Once combined net profit is found out, after that you have to split that combined net profit on the basis of relative contribution ratio. That will be given in the exam. What is relative contribution ratio? Relative contribution ratio means which company has put how much efforts, which company has put how much resources, money, wealth, employees, capital, etc. Based on that you have to give what? Apportion that much profit to that particular entity. Okay, a company who has put more effort, you will get more and more profit to that. A company who has put less efforts will give less profit to them. That ratio will be given in the exam. Obviously we don't have to find out all those things in the exam. Okay, so first of all find out the combined net profit of all the entity, and once that is found out, then find out, which is given in the exam only, the combined net profit will be given in the exam. For example, it is 10,000 rupees. Then find out the combined the relative contribution ratio. Suppose it is 50:30:20. So divide the ratio, divide the profit into or in this 3 ratio, and then give that profit to the respective authorities, to the respective associate enterprise, and accordingly every enterprise will add the cost to it and will arrive at its what? Arm's length price. So once you allocate profit to everybody, everybody will add their cost, add their respective cost, and you will get the arm's length price. It is as simple as that. Okay, now next one, cost plus method. Now what happens in this method? Let me give you again a background of this. I am suppose selling some goods to my associate enterprise, and I am also selling some goods to my unassociated enterprise, that is to third party. Okay, so first of all what I am supposed to find out is the cost which is associated to my associate enterprise. That is my first step. First step is when I am selling goods to my associate enterprise or when I am providing services to my associate enterprise, what is the cost? What is the direct and indirect cost in respect of that? So that is my step 1. After that, I have to find out the normal GP in respect of third party. In respect of third party, whatever is the normal GP? Suppose it is 50% of the cost. So I have to identify that. And then in this method, you are supposed to compare your international transaction with your uncontrolled transaction, and you have to make adjustments in what? In your GP margin. In here, this method you are not going to make adjustment in your price, but in this method you are going to make adjustments in your GP margin, and you will find out a revised GP margin, and that revised GP margin will be added to your cost, and then you will get your arm's length price. Okay, so this is what this method is all about. Let's come to the next method, that is transaction net margin method. The transaction net margin method is a very simple method whereby you will compare the net profit margin of two entities, one which is with your associate enterprise and one which is with your third party. Okay, now in that case you have to be very careful. When you are taking a net profit margin, in the numerator you are always going to take the operating profit, but in the denominator what you will take? In the denominator you are supposed to take what? In some cases you can take sales and in some cases you can take cost. So when to take sales, when to take cost? So in the denominator, if you are selling to someone, then in the denominator you take cost, and if you are purchasing from someone, then in the denominator you take sales. That is the logic which I have told you of tainted denominator, which I have told you in the class, if you remember that. Okay, so be very careful. For the purpose of revision, I cannot get into the detailing of that, but I am saying you something very important, otherwise your answers will go wrong. If you are selling to someone, then take in the denominator operating cost, and if you are purchasing from someone, then take in the denominator sales. Be very careful. And then you compare your margin with the margin of the unrelated party, and if there is any functional difference in the margin, if there is a functional difference between the two transactions, then you can what? Adjust the margin, and accordingly you will get net profit, and it will be what? The net profit will be used to arrive at your arm's length price. Check it please. So let's move ahead with the next point, and that is a very, very important point in practical life. That is generally what happens when you compute arm's length price. You have more than one arm's length price, then which one to take? If there are more than one arm's length price, then which one to take? Then you have to follow the concept of range concept, which is given under rule 10 CA. So rule 10 CA is applicable if there is more than one arm's length price. Okay, so now the question is how to follow that and which method is applicable, etc., etc. All those things that we need to understand. So first of all, you have to keep it in mind. I will say once again, if there are more than one arm's length price, then you have to follow what? Range concept to identify your correct arm's length price. Okay, now range concept is not applicable in some circumstances. First of all, it is not applicable for profit split method, and it is not applicable for the sixth method, which is any other method which can be prescribed by CBDT. It means it is only applicable for the first four method, that is cup method, that is your cost plus method, that is resale price method, and transaction net margin method. It is not applicable for PSM. It is not applicable for other method. They generally ask this question in your MCQs also. Secondly, it is applicable only for four methods. So out of the four method also, It is applicable if you have 6 or more entries in the data set. If you have less than 6 entries in the data set, it is not applicable. Okay, it is not applicable if there is less than 6 entries in the data set. So you need to have at least 6 entries in the data set, 6, 7, 8, 9, 10, whatever it is, it will be fine. Okay, now multiple year data will be used only in case of these three method. It means in case of cup method, you are not going to use what? Multiple year data. Multiple year data includes what? Includes the data of the current year and the last 2 years. So the data of the current year and the last 2 years have to be used in case of these three methods. But in case of cup method, you are only supposed to use the current year data. You will understand all these things if you have seen an example with me in class, which I have told you in the class, in the regular batch also, and in the fast track batch also. I have shown you a big example on this. So with the help of that example, you can keep that example in your front, and then you can understand what I am trying to say. Okay, otherwise it is very difficult to explain all these things. Okay, now let's talk about one of the methods, say TNMM. In TNMM, what you compare? You compare the net profit margin. Okay, so now what are you supposed to do in the practical life? For TNMM, how will you compute the range concept? Okay, so go to the market and find out 6 companies, at least 6 companies, or 7 companies, or 8 companies, or 9 companies, at least 6 companies, and get the operating profit and operating cost of the 6 companies of current year and the last 2 years. Okay, of current year and the last 2 years, because in TNMM you are supposed to take multiple year average. Okay, so go to the market for TNMM, get operating profit, operating cost of the company for the current year and the last 2 years of the 6 companies who are doing transactions with their unrelated party. Okay, so I got that. Now I have to take what? I have to add the operating profit of all the 3 years and operating cost of all the 3 years, and then I will get operating profit upon operating cost of all the 6 companies in front of me. Okay, now I have to find out the percentages of all of them. Okay, once I find out the percentages of all of them, then I have to go down and arrange them in an ascending order. So whichever is the lower percentage will be coming first, and whichever is the higher percentage which will be coming last in the order of that. Okay, lower to higher, you have to arrange them in the ascending order. So total how many entries you are taking? You can take 6, 7, 8. Suppose we are taking 7 entries. Okay, so now once you have done that, first of all, what are you going to do? Again, I am saying you go to the market, find out operating profit, operating cost of 6 similar companies who are doing transaction with unrelated party. Okay, then of the current year and the last 2 years, and then add the operating profit of the 3 years, add the operating cost of 3 years, and then divide that, find out the percentage. You will get 6, 7 percentages. You lay down them in the order of ascending order. Once you have done that, what have you supposed to do? Find out the number of data you have collected. Suppose we have collected 6 entries. So find out now 35% of 6. So now if the 35% of 6 is coming to what? A fraction, then go to the next number. Okay, then go to the next number. Then go to the next number, and if it is coming to a whole number, then take the average of that number and next number, and whatever the number will come, that will become the data set of 35th percentile. Similarly, take the 65th percentile of your 6 or 7 entries, whatever you have collected from the market. Suppose you have collected 6 entries, so take 65% of 6, or if you have collected 7 entries, then take 65% of 7. Then whatever answer comes, if it is a fraction, go to the next number, and if it is a whole number, then take the average of that number and next number, and that will become your range. Now if your arm's length price is within the range of this 35th to 65 percentile, government will accept that. But if it is not within the range, then you have to compute the median of 7 or median of 6, whatever number of entries you have collected. So if you have collected 7 entries, take the median of 7. Again you have to take, if it is a fraction, go to the next number. If it is a whole number, take the average of that number and next number, and that will become your arm's length price. And this is the exercise that you are supposed to do in this entire discussion of what? Range concept. The range concept is not applicable if the number of entries are less than 6. So what are you supposed to do in that case? In that case, you are supposed to merely do what? Arithmetic mean of all the prices. That's it. That will become your arm's length price. And that too, you have to compare that with your actual price. And if there is a difference of up to 3%, then don't have to apply the arm's length price. If there is a difference of more than 3%, then also you are supposed to, then only you are supposed to apply the arm's length price. Suppose for example, after applying the mean, suppose there are only 5 entries, so I cannot follow the range concept, then I have to take the arithmetic mean, and the arithmetic mean of the 5 items comes to what? Say 103 rupees, and your actual transaction price is 102 rupees. Now the difference between the two is not more than 3%, and if it is not more than 3%, then in that case you are not supposed to follow the range concept. This particular price also, you are supposed to follow the original price at which you have done the transaction. Okay, so you have to check this 3% criteria over there, which is very important. So this is what this range concept is all about. For further understanding, you can go to our textbook, in which we have given a detailed example for you all, and I have also made you take a photograph in your fast track batch of that particular detailed example. Okay, now the next one is a new concept which is added by the institute in the new course. It was not there in the old course. This is a bright line test. Now what is bright line test? Let me give you an example. Now all the foreign companies, if they want to operate in India, they have to open one subsidiary in India. For example, Sony will open a subsidiary in India. Samsung will open a subsidiary in India. Now, they tell the subsidiaries in India to do advertising, marketing, promotion in India on behalf of the parent company. Okay. So, Sony India will do advertisement, marketing, promotion on behalf of the Sony Japan. Okay. Similarly, Samsung India will do on behalf of the parent company. Now, whatever advertisement and marketing and promotion expenses they are doing, that expenditure the assessing officer is disallowing in excess of non-routine expense. The government says that, the assessing officer says that whatever expenditure you are incurring in the form of advertising, marketing and promotion expense, henceforth I am going to say it as an AMP expense. So whatever AMP expense you are going to incur in India, the AO is dividing all the AMP expense into two parts: routine expense, non-routine expense. Routine expense will be allowed as deduction, and excess, which is non-routine, excess which is non-routine, will be disallowed. Okay. This concept is known as bright line test. Now, the assessing officer is saying that I'm going to apply this concept of bright line test and I'm going to disallow the non-routine expense of advertising, marketing and promotion expenses. Now, the assessee said that you cannot disallow the non-routine expense. Why? Because the concept of bright line test is not prevailing in India. This is prevailing in foreign countries. It is prevailing in Western countries. But right now, the concept of bright line test is not prevailing in India. Therefore, the assessees challenge this concept in the court of law. And the Supreme Court and also the Delhi High Court in the case of Sony India and also in case of Bosch and Lomb has held that such bright line test cannot be applied by the assessing officer in India in the absence of a machinery provision. Because there is no exclusive provision of bright line test in India, the AO does not have any power to impose bright line test and disallow the non-routine expense. So this is what this concept is all about. I hope it is clear to all of you. Now let's go ahead with the reference to TPO. What is TPO? TPO is nothing but a transfer pricing officer who can be considered to be an expert in transfer pricing officer. It is an assistant commissioner or deputy commissioner of income tax law who is an expert of income tax, okay, of transfer pricing issues. Now there is a triangle over here. I am an assessing officer and there is an assessee over here. Okay, I am doing the assessment of the assessee. While doing the assessment, I have some issues with respect to what? Determining the arm's length price of the international transaction and determining the arm's length price of the specified domestic transaction also. So I can go to with the previous approval of CIT, I can go to the transfer pricing officer and I can tell the transfer pricing officer that I refer the matter to you and now you compute the arm's length price. Now the transfer pricing officer will give the notice to the assessee and will give the notice to the assessee and will ask the question to the assessee that how have you computed the arm's length price, and accordingly the transfer pricing officer will determine what? The arm's length price of the assessee. So I am a AO, I have an issue in determining the arm's length price of the international transaction and domestic transaction, so I can make a reference to TPO. So now suppose if I made a reference to TPO of X transaction, can TPO take the Y transaction without me giving my reference? Yes, he can take that in respect of an international transaction, but he cannot take that in respect of a domestic transaction. For domestic transaction, he can only compute arm's length price of those transactions which I have referred. But for international transaction, he can also take up transaction on his own without me referring him. If I have referred 3 transactions, he can take 3 more transactions on its own with respect to international transaction, but not with respect to what? Domestic transaction. That is practically not possible at the end of the what? At the end of the transfer pricing officer. Now, what the transfer pricing will do? How will the transfer pricing officer compute the arm's length price? He will compute the arm's length price by passing an order in writing, and he will send that order to the AO and also to the assessee. By when he will pass the order? He will pass the order at least 60 days prior to the completion of assessment. Whatever is the time limit to complete the assessment, he will pass the order at least 60 days prior to what? That particular assessment time limit. Suppose the assessment is completing on 31st of December 2024. So he will complete his order. He will pass his order at least 60 days prior to that particular date. That is by 1st of November 2024. Okay. Now. In some cases, the transfer pricing officer will get some extra time also. Like if there is an assessment which is kept on hold by any court, or because the assessee has put a petition in the court that the assessment is not done on right track, and therefore the court has what? Put your assessment on hold. So if the assessment has been kept on hold by the assessing or by the court, or if there is some information which has to come from the foreign authorities, so the assessment might pause for some time. Say it was paused for 50 days. So that 50 days you will get extra, no doubt. But whenever the assessment will be resumed after that, you will at least get 60 days to complete your order. Okay, the transfer pricing officer will get at least 60 days after that also to pass his transfer pricing order. So be very careful. Suppose the assessment is held or hold because of some reason, like it is mentioned over here. Now, suppose it was hold for 50 days. So you will get that 50 days, no doubt. You get that extension of 50 days. But apart from that, you will also get at least 60 days to complete what? To complete the order which is passed under this section. Next. Can TPO make mistake? Yes, why not? He can make a mistake. And if he is making an apparent mistake, he will rectify the order as per section 154. Now, whatever TPO says now, it is binding on the assessing officer. So, whatever TPO will say, it is binding on the assessing officer. And if it is binding on the assessing officer, then even assessing officer has to what? Rectify the order of assessment. Because if TPO has made a mistake, then even AO would have made a mistake. So, in that case, even the AO has to what? Rectify the order, assessment order immediately. Next. Does the TPO has the power? Certain powers have been given to TPO. Yes, TPO has been given certain powers like to issue summon. TPO may call for information under 133. TPO may also conduct survey, and last but not least, the government has said that till 2024 we are going to make this entire proceeding of TPO as what? As a faceless proceeding. Check it please. Now let's move on to the next concept that is given under section 92D, that is information and documents. Every assessee entering into an international transaction or specified domestic transaction, they have to maintain certain documents and information, and they have to maintain those documents and information for a period of 8 years from the end of the relevant assessment year. Okay. Now, is every assessee who is liable for transfer pricing is supposed to maintain these documents? The answer is no. This is only supposed to be maintained by those assessees whose value of international transaction or whose value of transactions in the entire year exceeds 1 crore rupees. If your value of transaction in the entire year does not exceed 1 crore rupees, then you don't have to maintain all these documents. Okay. So the threshold, there is a threshold to maintain the document. But remember, there is no threshold under the income tax law to do transfer pricing. Transfer pricing is applicable even if you do a transaction of 10,000 rupees. The threshold is not for transfer pricing. The threshold is only for maintenance of documentations. Okay. So if you want to compulsorily maintain, then your aggregate value of transaction in the entire year should exceed 1 crore rupees. Okay. Now, even if it does not crosses 1 crore rupees, then also you have to maintain at least some documents through which you can prove to the department that your transfer pricing, your arm's length price is proper. Okay. So remember, if your aggregate value of transaction exceeds 1 crore rupees, you have to maintain all the prescribed documents. If it is less than 1 crore rupees, you have to maintain some documents at least to prove your genuineness that your arm's length price is correctly computed. Now, what all documents we are supposed to maintain, that is mentioned in Rule 10D. Let me go through all of them. First of all, you need to maintain the profile of the multinational group. The entire multinational group has a profile. What does the multinational group exactly does? Okay. The ownership structure, which company has how much shareholding in which particular company, brief description of the business, nature and terms of the international transaction, whether your nature of transaction is royalty, FTS, interest, etc., what kind of transaction it is. Okay. Next, financial estimates, that is your ratio analysis, budget, forecast, nature and terms of uncontrolled transaction. Uncontrolled transaction mean the transaction with the unrelated party. Analysis of the comparison. While doing the transfer pricing analysis, you compare your controlled transaction with your uncontrolled transaction. So I want that analysis also. I want the arm's length price, actual working of the arm's length price, method adopted, reason for adopting the most appropriate method, and adjustment mean. I also want to know the GP margin. This is all the department demands. Okay. Then published account, that is your books of accounts, price publication if the shares are listed in the stock market. Okay. Then agreement and contract of international transaction, as well as agreement and contract of uncontrolled transaction. All these documents have to be maintained for how many years? All these documents are to be maintained for a period of 8 years from the end of the relevant assessment year. And there is a small amendment made by Finance Act 2023 over here, that if AO or CIT appeal calls for the documents, then you have to give those documents within 10 days. Earlier, we had to give these documents within 30 days. Now you have to give these documents within 10 days. Okay. So the 30 days has been reduced to 10 days. This is a small amendment made by Finance Act 2023. One last thing. If you want extension, if you feel that being an assessee, you will not be able to give the documents within 10 days, then you can make an application for extension and you will be given 30 days extension. Okay. So earlier it was 30 plus 30. Now it is 10 plus 30. I hope it is clear to all of you. Now let's move on to the next one, which is the master section for documentations, which is very, very important. Now CBDT has said that you have to divide all the documentations into 3 parts. One is local file, one is master file, and one is country by country reporting. Let me give you a synopsis of all 3 of them. Local file is something which you have just learned. The documents which you have learned just now, that is a local file. Okay, it is applicable for all those assessees whose aggregate transaction exceed 1 crore rupees. Okay. Now, what is master file? Master file, you have to give some big informations applicable to certain assessees who are crossing certain threshold. If you are crossing certain threshold, master file will be applicable, that we are going to learn in a while. Okay. And country by country reporting, what happens in this case? Listen carefully. In country by country reporting, what happens? You have to report the transaction of with every country with which you are dealing. It means, suppose if I am Reliance Industry and if I have a subsidiary in 50 countries, then I have to give the data of the 50 countries to the income tax department. And where you will file? You will file in the country in which your parent company is resident. Suppose the parent company of Reliance is resident in India, so Reliance will file in India. For Sony, it is in Japan, so Sony will file in Japan. For Apple, it is in US, so Apple will file in US. So wherever your ultimate parent company is resident, in that country you will file the country by country reporting. So for example, Sony Japan will file in Japan, and if India wants that information, then India and Japan will have an automatic exchange of information agreement, and through that agreement Sony Japan will share that information with the income tax authority in India. Okay, so in India also Sony is there, but Sony's parent company is not there in India. So wherever is the parent company, that country will file what? The CBCR. So first of all, the very first thing which we need to understand, CBCR is applicable to which companies? It is applicable only to those companies whose consolidated group revenue in the last accounting year, not in the current accounting year, in the last accounting year is above 6,400 crore rupees. So if the consolidated group revenue in the last accounting year is greater than 6,400 crores, then only CBCR is applicable, otherwise CBCR is not applicable. Now, Reliance Industry, is it covered in this? Definitely it is covered here because the Reliance Industry's total group revenue will be definitely greater than 6,400 crore rupees in the last year. Now, who will file the CBCR? CBCR will be filed by either parent entity who is a resident in India or an alternate reporting entity who is a resident in India. Now you will ask a question, who is alternate reporting entity? Alternate reporting entity is nothing but an entity who has been given the power to file the CBCR. Suppose Sony Japan says that I am not filing CBCR, but they have given that, delegated that authority to Sony India. Then Sony India will become what? Alternate reporting entity. Okay, so Sony India will become an alternate reporting entity. So parent entity can also file. Suppose Reliance Industry is a parent entity, that can also file. And if Sony Japan has delegated that authority to Sony India, then they will also file. They will file CBCR to whom? They will file the CBCR to Joint Director designated by Principal Director General of Income Tax or Director General of Income Tax System for every accounting year within 12 months from the end of the month for which it is relevant. Okay, so for financial year 22-23, they will file by 31st March 2024. So for financial year 22-23, they will file by which date? 31st March 2024, and it will be filed in Form 3 CEAD. Okay, next. Every constituent entity. First of all, you will ask me a question, what is a constituent entity? A constituent entity is an entity which is a part of CFS. So every company which is a part of CFS is called as a constituent entity. Even if a company is not part of CFS, because of some reason, that company can also be called as a constituent entity. And even a foreign company's permanent establishment in India can also be called as a constituent entity. So the constituent entity has some responsibility. So suppose, I'll give you an example. Sony India is a constituent entity. Now Sony India has a responsibility to notify to the joint director, etc., at least 2 months prior to the due date of furnishing CBCR. The due date of furnishing of CBCR is 31st March 2024. So 2 months prior to that will come to 31st Jan 2024. So Sony India will intimate the joint director of income tax at least 2 months, and it will tell the income tax department that whether Sony India is an alternate reporting entity. If it is an alternate reporting entity, then the Indian government will take CBCR from Sony India, and if it is not, then who is the alternate reporting entity? Who is the parent entity? Indian government wants to know at least 2 months prior to the filing of CBCR who is ultimately going to file the CBCR. Are you going to file the CBCR, Sony India? If yes, tell us, notify us. If you are not going to file, then who are going to file? Tell us. We will do an automatic exchange of information agreement with them, and we will get the agreement from them. Okay, next. What does CBCR contain? CBCR contains some basic information like revenue, profit before tax, income tax, details of stated capital, accumulated earnings, tangible assets other than cash and cash equivalents, etc., your main business activity, etc. They will have some basic information which will be covered in your CBCR report. Next. Pay attention, please, all of you. Very important. Next point. Let me give you an example. India is there, Japan is there. Okay. Now, Sony Japan is there in Japan, and Sony India is also there in India. Sony India is a subsidiary, Sony Japan is a parent entity. By default, who will file CBCR? Sony Japan will file CBCR. But there are 3 problems now. First, in Japan, there is no concept of CBCR. Second, in Japan, there is a concept of CBCR, but India does not have an agreement with Japan to exchange the agreement. Third, in Japan, there is a concept of CBCR and India has an agreement with Japan. But Japan does not share the agreement with us properly. They have a systemic failure in sharing the agreement. In all the 3 cases, the Indian government says that the Indian entity, Sony India, will file CBCR check. And if there are more than one constituent entity, then the group will nominate one entity in India. Suppose if there are two subsidiaries in India of Sony, then the group will nominate one of them to be responsible to file CBCR. Check it please. This is what this point number 5 and 6 has to say. So there are three problems which I have raised you. No concept of CBCR, no agreement, there is a systemic failure in sharing the agreement. So in these three cases, Sony India will file the CBCR. Okay. Next. Again, I have to make a triangle of three countries. There is Sony Japan and Sony Germany and Sony India. Now, suppose Sony Japan has given the responsibility to Sony Germany to file CBCR and said that Sony Germany will be alternate reporting entity. And Sony Germany is sharing the information with us regularly. Whenever we are asking Sony Germany, they are giving us the information. So, in that case, Sony India will not be liable to file CBCR. Check please. So, if Sony Japan is giving the responsibility to Sony Germany and Sony Germany has an agreement with India and they are giving us information all properly, all the agreement, then Sony in India will not be liable to file CBCR. Check please. Last but not least, the joint director or the designated principal commissioner of income tax, they will call for some information. You have to give them information within 30 days. You can also ask for an extension and they will give you a further 30 days extension, and within that 30 days you have to give them all the information as mentioned over here. Okay. They want to verify certain information, so they might ask you for certain information, so you have to give them all the information which they ask from you. Okay, because they have a CBCR, so they want to verify a lot of things, so they will ask you some information, so you have to give them within the time mentioned over here, that is 30 days plus extension of 30 days. If you do not give, there will be a penalty which is going to come now. Now, what is the penalty for not furnishing the CBCR? For first 1 month, it is 5,000 rupees per day. You have to file by 31st March. If you don't file by 31st March, from April, 5,000 rupees per day. After a month, 15,000 rupees per day. And after that, the department will send you an order of penalty, that this much is your penalty. After that also, if you don't pay and if you don't file the CBCR, then 50,000 rupees per day. So first 1 month 5,000, then after that 15,000, then the department will send you an order of penalty. After that also you don't file the CBCR, then 50,000 rupees per day. Check. Second, as I have told you, the CBCR authority, that is joint director, principal director, they will call for certain information and you have to give them within 30 days. If you don't give them within 30 days, then 5,000 rupees per day. And after that, they will send you a penalty notice. And even after that, if you don't give them, then it is 50,000 rupees per day. I am talking about this point. If you violate this particular condition, then there is a penalty of 5,000 rupees for first few days. And after that, when they send you a notice of penalty order, after that also don't reply to them, then 50,000 rupees per day. Okay. Next. If you file CBCR and give some inaccurate information in the CBCR, then a penalty of 5 lakh rupees. You are filing CBCR, but you are giving inaccurate information. Then 5 lakh rupees penalty if you had the knowledge of inaccuracy at the time of furnishing. You knew that you are filing, whatever you are filing, whatever you are putting the information that is wrong, still you give that wrong information, 5 lakh penalty. Or if you discover that information later on and if you do not rectify within 15 days, then also penalty of 5 lakh rupees. One is when filing the information, you were aware that you are filing a wrong information, 5 lakh penalty. One is when filing the information, I was not aware. Later on, I came to know. And in 15 days, I do not rectify, then also 5 lakh penalty. Next. And if you give in response to the notice, if the department is asking you the information over here and you are responding them in a wrong manner, you are responding and giving them a wrong information, inaccurate information, then also there is a penalty of 5 lakh rupees. Check it over here, please. Okay. Now coming to the discussion of what master file. Master file is applicable to whom? Master file is applicable to all those assessees who are fulfilling two conditions. Condition number 1 and in condition number 2, either A or B, either of the two, not both, either of the two. Condition number 1 is your current year consolidated group revenue has to be greater than 500 crore rupees. Your current year's consolidated group revenue has to be greater than how much? 500 crore rupees. And your value of international transaction during the year as per the books of accounts has to be either 50 crore, your aggregate international transaction has to be greater than 50 crore, or if your aggregate international transaction is not greater than 50 crore, but either your sale is greater than 10 crore, or your purchase is greater than 10 crore, or your transfer is greater than 10 crore, or your lease is greater than 10 crore, you are liable for filing of CBCR. Along with what? Your global revenue should exceed 500 crore in the current year. Okay, be very careful. So this condition you have to fulfill. But out of these two, you have to fulfill either aggregate 50 crore should cross or individually 10 crore should cross. Okay, in that case, you have to file CBCR. And in CBCR also, there are two parts. Part A, everybody has to file, whether you fulfill these conditions or not. Part B, part A has some basic details here that everybody has to fulfill. But part B is something which is having some great details that will only be filled by those people who are fulfilling these two conditions. Okay, check it please. So let's move on to the next point, and that is report from CA. Every transfer pricing assessee who is entering into international transaction or specified domestic transaction has to obtain a report from a CA in form 3CB by 31st of October, and it has to be filled by 31st of October. If you fail to file this report, then there is a penalty of 271 BA of 1 lakh rupees. 1 lakh rupees penalty under 271 BA, you have to pay it. Okay, you have to pay that. Okay. Now, what is there in that report? In that report, you have to list all the transactions, international transaction and domestic transaction that you have entered. Okay. You have to mention all the transactions. So, if you fail to mention those transactions, then 2% of the value of transaction. So, if there are suppose 10 transactions, out of that you have only mentioned 8 of them, 2 are not mentioned, you missed 2 transactions. So, on that 2 transaction, you have to pay 2% of the value of transaction. Now, suppose what if I don't file the report only? Then you are be liable for 2% of the value of transaction also, and you will be liable for 1 lakh rupees also. Because if you do not file the report, then you are doing both the default of not filing the report also and on not reporting the transactions also. Be very careful. That is something which is very important. Okay. Now, apart from that, there are many other penalties that you have to understand one by one over here. This chart is very important. First of all, which I have told you just now, 271 BA 1 lakh rupees for not submitting form 3CB. 271 AA 2% of the value of transaction if you do not report the transaction in form 3CB. There are 2 more reasons because of which 271 AA can be imposed on you. 2 more reasons. One is what? 92D1 and 92D2. What is 92D1 and 92D2? Let me tell you. If you do not maintain all the documents as per 92D1, if your transaction value is more than 1 crore, still you are not maintaining all the documents. And 92D2 talks about if you do not maintain the documents for a period of 8 years, then you will be liable for a penalty of 2% of the value of transaction. And the third point maintained over here is you are maintaining the documents, you are maintaining the information, but you are maintaining incorrectly, wrong information, wrong document. Then what sense does it make? Then also 2% of the value of transaction. So 271 AA can be imposed because of 3 reasons. One, because you are not mentioning the transactions in the form 3CB. Second, because you are not maintaining the documents information for 8 years. And third, you are maintaining the documents information, but you are maintaining for in an incorrect manner. In all the 3 reasons, 271 AA can be imposed. Apart from that, if you do not report a transaction, there will also be a misreporting of income which will be considered, and there will be 200 penalty. 200% of the tax payable will be imposed as penalty. So for if you do not report a transaction, there is one more penalty here which is coming, which is 200% of your tax payable. That penalty will also be imposed on you over and above what? 271 AA, 271G and 271 BA. Over and above all this penalty, 270A will also be imposed, 200% of the tax payable. Last but not least, there is one more penalty over here, which is 271G. What does it say about? It says that if the AO is calling for the information and the CIT appeal is calling for the information, you have to give the information within 30 days. It is mentioned in 92D3. Do you remember that? That you have to give the information within 30 days. They might also give you an extension of another 30 days if you request to the AO or CIT appeal. So if you do not give them the information within time, then the respective authorities will impose penalty under 271G at the rate of 2% of the value of transaction. Check it over here. Okay, I hope it is clear to all of you. Now let's move ahead with the next point, which is extremely important and a very big one, and that is 92CC and 92CD. Sir, what is 92CC? 92CC talks about advance pricing agreement. Sir, what is advance pricing agreement? Advance pricing agreement is an agreement which you enter into with CBDT, whereby CBDT will determine your arm's length price, or either it will tell you the manner in which arm's length price has to be determined, so that there is no question raised on your arm's length price. Nobody can raise any question, and once CBDT determine the arm's length price, then nobody will raise any question. The AO cannot raise any question, the CIT appeal cannot raise any question, the CIT cannot raise any question, the TPO cannot raise any question, you also cannot raise any question, you also cannot appeal against that. Now this arm's length price, this advance pricing agreement is entered after a prior approval with the central government. Approval of central government is must, and this agreement is entered into for a period of maximum 5 years. 5 consecutive PYs it is entered into. And now to enter into this agreement, you have to make some heavy payment of fees. That is, if the value of transaction is up to 100 crore, you have to make a payment of 10 lakh rupees as fees. If it is more than 100 crore but up to 200 crore, then 15 lakh rupees is the fees. And if it is more than 200 crore, then 20 lakh rupees is the fees. Application once made can be withdrawn by you. You can withdraw the application, you can back out if you want, but the fees once paid will not be refunded to you. Don't worry. Don't worry what you have to worry about it. Once you pay the fees, you are not going to get any refund of the fees which you have paid to the department. So these are the few points which you have to keep it in your mind when you are talking about what? Advance pricing agreement. Once advance pricing agreement is signed, it is signed for a period of 5 years. It overrules 92C so that AO does not interfere. It overrules 92CA so that TPO does not interfere. It is binding on everyone, CIT, SSC, AO, so that all these people cannot raise question later on. CIT appeal cannot raise question, AO cannot raise question, even SSC cannot file an appeal to CIT appeal later on. Okay, now this is what the first part of this section is all about. The entire objective of this particular particular provision is what? The certainty in a determination of arm's length price. Once I determine the arm's length price, nobody should raise a question. Otherwise, my mind will be always towards that only. I will not be able to focus on my business. So if you are doing a transaction with your associate enterprise, go to the CBDT and make an application for what? Advance pricing agreement. And once they find out the advance pricing agreement, once they find out your arm's length price, after that you don't have to worry about all these things, that what AO will say, what TPO will say. Nobody will say anything. That is binding on everybody. Okay. Now this is applicable for 5 years. Now which 5 years? Which 5 years? That will be written in the agreement. Which 5 years? That will be written in the agreement. Say for example 31st March 2019 to 31st March 2023. These are the 5 years. Now these are which 5 years? These are financial year 18-19 to financial year 22-23. Okay, so these are the 5 years which are covered over here. Okay, now suppose for example the SSE has made an application. Suppose, pay attention, pay absolute attention. Suppose the SSE has made an application to the CBDT on, say, in the month of July. Pay attention, in the month of July 2019. Now you have to pay absolute attention because this is the tricky part. Now suppose you have made an application to CBDT in July 2019. Okay, for these 5 years you have made an application to CBDT for the purpose of arm's length, for the purpose of advance pricing agreement. Now CBDT is there in its own mode only. Now they are signing the agreement after a year almost, on 1st September 2020. Now please pay attention, on 1st September 2020, please tell me whether the books of accounts of this year is closed or not, whether the books of accounts of 18-19 is closed or not, whether the ITR due date of 18-19 is gone or not, whether you have already filed the ITR in the last year or not. On 30th November 2019 you have filed the ITR, but after filing of ITR, after 8-9 months after filing of ITR, CBDT is signing the CBDT agreement of advance pricing agreement. Now what has to be done? Now the government says that the return is already filed for 19, and after that what CBDT has signed what? The advance pricing agreement. Now the government said that whenever the agreement was signed, when was the agreement signed? In September 20. Within 3 months from the end of the month, assessee has to file a modified return. Assessee has to file a modified return within 3 months from the end of the month, that is till 31st December 2020, and accordingly if the assessee files the modified return within 3 months from the end of the month in which the agreement was signed, the assessment of the assessee will be done as per the modified return and not as per the old return. Now there is a second possibility. Second possibility is what? The return is filed and the assessment is also completed before 31st December 2020. I can file modified return till which date? Till 31st December 2020, I have the time to file modified return. But the AO is in a hurry and AO completed the assessment on 30th November 2020 only. Assessee should not worry about it. Assessee has to do his job properly. Assessee should file the modified return by 31st December, and AO will be bound to modify the return of the assessee, and he will modify the return within 1 year from the end of the financial year in which the return was furnished. Okay, so don't worry. Even if the assessing officer has completed the assessment, you don't have to worry. You have to do your job properly. You file the modified return by 31st December 2020. How will I arrive? How I arrive at 31st December 2020? Within 3 months from the end of the month in which the agreement of APA was signed. Okay. Next. What if the return is filed and the assessment is pending on the date of filing the modified return? Don't worry. You do your job properly. If the assessment is pending on the date of filing of modified return, that is on 31st December 2020, don't worry. The AO will complete the assessment as per the modified return, and the department will give him extra 1 year to complete the assessment. That is, generally it is 9 months from the end of the relevant AY. But in this case, the government will give them 9 months because they want some extra time now, because in between I am filing a modified return. So they should get some extra time and they will get an extra time over here. Don't worry. Okay. Now, advance pricing agreement, is it mandatory always on everyone? Is it binding on everyone all the time? Not necessary. Advance pricing agreement is not binding in certain cases. If there is a change in law in future, then advance pricing agreement is not binding. If there is a change in facts of the agreement in future, then advance pricing agreement is not binding on the assessee. Or if later on the department comes to know that there was a fraud which was done by assessee, or there was a misrepresentation of facts which was done by the assessee, then advance pricing agreement will be void ab initio and all the provisions of the income tax law will apply, and the assessing officer will get the extra time to complete the assessment, to send the notice, and all those things the assessing officer can do on your behalf. Check it please. So in case there is a change in law, advance pricing agreement is not applicable, then the new law will be applicable. In case there is a change in the facts of your transaction, facts of your agreement, then advance pricing agreement will not apply, then the new facts will apply. As per the new facts, the arm's length price will be determined. Or if there is a fraud or misrepresentation of facts done by you, then the advance pricing agreement is void ab initio from the very beginning. Check it please. Now let's talk about the extension of this provision, that is rollback provision. Now what do I mean by rollback? Now there is a two different term which you need to understand very carefully. APA, advance pricing agreement, is for future 5 years. And rollback is for last 4 years. Rollback is for last 4 years. Now the government is, now the assessee is saying that also give me the benefit of advance pricing agreement for the past years now. Why to unnecessarily fight for past years with the department? Extend the benefit for the past years also. The government said that yes, we will roll back this provision to the last years also, subject to 5 conditions. First, the international transaction of your future year and the past year has to be same, first of all. Second, you should have filed the return of the past 4 years on time, on or before the due date of filing of return. Third, you should have furnished form 3CB properly on time of the last 4 years. Okay. Fourth, the applicability of this has been requested for all the rollback years. You have to apply for all the rollback years. You cannot be selective in that case, that I want to apply for 3 years or 2 years. You cannot be selective. So you have to you come for all 4 years, or else you don't come for any of the year. Last, you have to make an application with fees of 5 lakh rupees. Sir, I have already paid a fees of 10 lakh, 15 lakh, 20 lakh. That is for future year. For rollback, you have to pay another 5 lakh rupees. The government has become very, very, very hungry now of money. So they want money at every step. Okay. So check it please. So you can get what? You can get the rollback benefit if you fulfill these 5 conditions. What are the 5 conditions? The international transaction of future year and past year has to be same. The return has to be filed for the earlier years on time. The report of the earlier years should also be filed as per 92E. And you should make an application for all the rollback years. You cannot be selective that 3 out of 4, 2 out of 4, 1 out of 4. You cannot be selective. And you have to make an application of 5 years, of 5 lakh rupees. Okay. You have to make an application. You have to make a payment of fee of 5 lakh rupees along with the application in form 3C EDA. Now, this provision will not be applicable. Rollback will not be applicable in certain cases. First case is if your matter has went to ITAT. If your matter of earlier year has went to ITAT and ITAT has passed an order disposing of the order at its end, ITAT has already closed your matter, then in that case you cannot go for what? Rollback. Rollback is not possible. Second, rollback is not possible if because of rollback the income is reducing. If because of rollback the income of past year is reducing, or if the losses of past year is increasing, then rollback is not possible, not possible, not possible. Check it please. Now, there is a CBDT circular over here explaining certain points of the conditions, clarifying certain points in the condition. One of the condition is that the applicant has to make an application for all the years, or else he does not have to come for rollback. He cannot be selective. Now, what if he does not satisfy conditions, basic conditions in some of the years? Say, for example, out of the 4 years, in some of the year, he has not filed the return, okay, on time, or in some of the year, he has not, say, for example, he does not have the transaction also. Same international transaction is not there, or in some of the year he has not filed the report of form 3CB. Can he go for the remaining 3 years? Yes, in that case he can go for the remaining 3 years. By default, applicant has to make an application for all the 3 years, but if in some of the years he has not fulfilled certain basic conditions, then he can go for the remaining number of years. Okay. Next step. One of the conditions of rollback is that for rollback year you have to file the return on time. Is it possible if I file the return under 139.5? Yes, it is possible if you have filed the original return under 139.1 and then you revise under 139.5, then you can go for rollback. But if you have filed the original return under 139.4 and then you have revised and now you are planning to roll back, rollback is not possible. If original return was filed on time and then it was revised in 139.5, it is possible to roll back. But if the original return itself was belated and then you revise that under 139.5 and then you want to roll back, then rollback is not possible under that case. Okay. Third point, one of the condition of rollback in the previous page was the transaction, the international transaction of future year and past year has to be same. What do I mean by same? Same means same nature. You royalty, FTS, transfer of asset. The nature of the transaction has to be same. Further, it has to be with the same AE. It has to be with the same associate enterprise only. The transaction of future and the transaction of past cannot be with some different associate enterprise. It has to be with some same associate enterprise. Is the FAR analysis, that is functions, assets and risk analysis, also need to be same? It need not be 100% same, but it should be not materially different from each other. FAR analysis is materially same, more or less it has to be same. It means the choice of method should be same, the comparability analysis should be same, the most appropriate method has to be same, the for the comparison purpose, the data which you are collecting, that has to be same, but it need not be 100% same. So what do you mean by the term the transaction has to be same? Because it is written very clearly in the condition number 1 over here that the transaction has to be same. What do I mean by that? It has to be of same nature with same associate enterprise, but the FAR analysis might not be 100% same, it might be materially same. Okay. Next. One of the condition which is given on the previous page over here is rollback is not applicable if your total income reduces or if your losses increases as compared to the income in the return of income. So for example, if my return of income, listen carefully, be very careful, I am explaining with the help of an example. If your return of income showing an example, income of 100 rupees, and if your TPO has increased the income to 120 rupees, and because of rollback, if the income reduces to 90, now the rollback provision cannot be made applicable because rollback cannot reduce your income below 100. Now, if you say to the department, I am ready to accept 100 rupees as your income, then rollback will be applicable. Your income should not go below 100. Income should not go below the income declared in ROI. It can go below the income declared by TPO. It can go below the income declared by the assessing officer, but it should not go below the income declared by the ROI. Okay, so in the ROI, if declaring 100 and if the TPO increases to 120 and if the because of rollback it is coming to 90, you can tell the department I would accept the price as 100 rupees. Please allow me the rollback provision, and they will allow you. Okay, now does the assessee has an application option to withdraw the rollback application? Yes, assessee has the application has an option to withdraw the rollback application without going for, and it can go only for future year. Thus the converse is possible. Can assessee go for only rollback without future? Only rollback without future is not possible, but only future without rollback is possible. Future transactions you can go and rollback we can withdraw, but rollback you want to do and future you want to withdraw, that is practically not possible. Check it please. Next, how rollback will be applicable in case of merger. Okay, now merger means there is an amalgamation of one or two companies. How rollback will be applicable in that case? Suppose for example, I am A Limited and you are B Limited. Okay, and I am acquiring you. Then I can go for rollback because I was the applicant who is making application for future year. Okay, so I am A Limited, you are B Limited. I am acquiring you. I am making application for future year. I can also go for past year. Okay, but if I am and you are merging and becoming a new company, C company. Okay. A and B are merging and becoming a C company. Now C is making an application. Now C is an applicant. A and B are not applicant. So A or B cannot go for what? Rollback provision. Check it please. This is what it wants to say. So if A takes over B and if A makes an application for future transaction, A can also go for rollback. But if A and B merge and become C, and if C makes an application for future years, then A and B cannot go for rollback. This is what this provision has to say, and this is what the rollback provision is all about, and this one is very important. Okay. Now let's move on to the next section, which is again a very important section, limitation of interest, where government is going to limit your interest to a particular percentage. They are not going to give you deduction more than a particular percentage. Now this section is applicable to whom? The borrower has to be Indian company or either a permanent establishment of a foreign company. The borrower has to be either of the two person. Okay, now what the borrower has to do? The borrower has to raise money from non-resident associate enterprise. I am a borrower, I am Indian company, I am permanent establishment of a foreign company. I have to raise money from what? Associate enterprise. I have to raise money from my associate enterprise who is non-resident. Plus, I can also raise money from some other people which can be called as deemed debt. Who are those other people? I can raise money from third party and my associate enterprise should give him guarantee. Okay, my associate enterprise should give him guarantee. I am raising money from third party and my associate enterprise is giving guarantee. Then that interest will also be covered under 94B. One more thing is covered under 94B, where I am raising money from third party and my associate enterprise is depositing a matching amount. Suppose my associate enterprise has deposited 5 crore rupees with third party and that third party has given me 5 crore rupees as loan, then that will also be considered as what? Deemed debt. Okay, so these are the 3 points which are covered. If I directly take loan from my associate enterprise which is non-resident or from these 2 categories which are third party, all 3 cases will be covered under 94B. Now this section will not be applicable if the interest is paid in respect of debt is issued by a lender. If the debt is issued by whom? A lender who is a P of a non-resident. A non-resident is outside India. That non-resident has a P in India and that P is engaged in the business of banking. For example, the non-resident is outside India, say in UK, and that non-resident has a branch in India which is a bank, and that bank is giving me loan. Then interest will not be disallowed under 94B. I hope it is clear to all of you. Now, what is there any threshold for disallowance over here? Yes, the entire year annual payment of interest should exceed 1 crore rupees and it should be allowed as a deduction under PGBP. So the deductible expense in the entire year should exceed how much? Should exceed 1 crore rupees. Further, this section is not applicable to few people like if the borrower is a banking company, this section is not applicable. If the borrower is an insurance company, this section is not applicable. And one last point is an amendment made by Finance Act 2023. If the borrower is an NBFC which is notified by central government, so if the borrower is an NBFC notified by central government, then also this section is not applicable. Okay, so the third one is an amendment made by Finance Act 2023. Now the next one is how much interest will be disallowed. The interest will be disallowed to the extent of lower of the 2 points. First one is you have to compute 30% of EBITDA and then compare with your interest. Okay, then total interest minus 30% of EBITDA. So total interest minus 30% of EBITDA or interest paid to associate enterprise minus 30% of EBITDA. Both the views can be taken. In point number 1, there are 2 views which are possible. One is you compare total interest with 30% of EBITDA. Another, you compare interest paid to AE with the 30% of EBITDA. Both of them are correct. Obviously, the answer will differ drastically in both the cases, but both of them are correct. Okay, so in point number 1, you can first compare your total interest with your 30% of EBITDA and take the difference, or you can compare only the interest paid to AE with 30% of EBITDA and take the difference. Point number 2 is same for everybody, that is interest paid or payable to associate enterprise. Whatever interest is disallowed, don't worry, it is a permanent disallowance. Don't worry, it is not a permanent disallowance, sorry, it is a temporary disallowance that will be allowed to be carried forward for the 8 years, and you can take the deduction of that in the subsequent years. Okay, so whatever interest is disallowed under 94B, that will be allowed as a deduction in the subsequent years. For 8 financial year, you can carry forward and set off that. Okay, I hope it is clear to all of you. So let's move on to one more very important point, very important provision for your exam, that is the adjustment of secondary adjustment, which is very important. Now to do secondary adjustment, first you have to make a primary adjustment. What is a primary adjustment? Primary adjustment is nothing but your transfer pricing additions. That's it. Your transfer pricing additions are your primary adjustments. So what is primary adjustment? It can be done by whom? Primary adjustment is nothing but the difference between the arm's length price and the price at which you do the transaction. Suppose if you are selling something at 3,000 rupees, but the arm's length price is 5,000 rupees. So the difference between the two, 2,000 rupees is your primary adjustment. Now, primary adjustment can be done because of many people. First, it can be done because of the assessee suo motu. If the primary adjustment is done because of assessee suo motu, secondary adjustment is possible. Primary adjustment can also be done by the AO or appellate authority, and the assessee should accept that. Assessee should not appeal. If the assessee appeals to the higher authority, then secondary adjustment is not possible. If the assessee accept that, then secondary adjustment is possible. Primary adjustment can also because of safe advance pricing agreement. Primary adjustment can also happen because of safe harbor rule, and it can also happen because of the DTAA adjustment. So every time you need to understand that to do a secondary adjustment, it is mandatory to do a primary adjustment. Secondly, the primary adjustment has to be greater than 1 crore rupees. If the primary adjustment is not greater than 1 crore rupees, then this provision is not applicable. If it is up to 1 crore rupees, secondary adjustment is not applicable. Further, if the primary adjustment is done in AY 16-17 or earlier year, then also secondary adjustment is not possible. It means the primary adjustment has to be done in AY 17-18 or in subsequent years. Otherwise, secondary adjustment is not possible. Okay. Now, what exactly primary adjustment is all about? Primary adjustment is nothing but primary adjustment is nothing but the extra loan which you have given to the other person. Now, tell. Suppose you have made a payment of what? You have made a payment of 300 lakhs rupees to the other person, but the arm's length price is only 100 lakhs. So 200 lakhs is extra payment. So that extra payment is nothing but considered to be a deemed loan. So the government says very clearly that you have to bring that money to India within 90 days. Within 90 days from where? Within 90 days from where? In case of point number 1, 3, 4 and 5, that is in case of this point number 1, 3, 4 and 5, you have to bring that money to India within 90 days from the due date of filing of return. And in case of point number 2, you have to bring that money back to India within 90 days on the date of order of assessment. So if you bring that money within 90 days from the due date of income tax return or due date of assessment, whichever is applicable in whichever case, then no interest will be charged on you. Then no tax will be charged on you. No deemed loan will be considered. Be very careful. Who should bring back the money to India? The money can be brought back by any non-resident associate enterprise in India. It is not necessary that it should be brought back to India. It should be given back to India by the same associate enterprise. It can be brought back to India by any non-resident associate enterprise. So you have to bring back money in India within 90 days from the relevant due date. So in case of point number 1, 3, 4 and 5, it is 90 days from the due date of filing of return. And in case of point number 2, it is 90 days from the date of order. What if I do not bring the money within 90 days? Then interest will be charged. Interest will, at what rate will be charged? That depends upon in what currency the transaction is denominated. If the transaction is denominated in INR, then interest will be charged at 1 year marginal cost of lending rate as on the first day of the relevant previous year plus 3.25%. So in whichever year you are charging the secondary adjustment, 1st April of that year you have to take the rate and plus 3.25%. If the transaction is in foreign currency, so first you have to convert that transaction into INR as per the TTBR as on the last day of the previous year. First convert that foreign currency transaction into INR and then apply 6 months LIBOR as on 30th September plus 3%. So first you have to identify the transaction. When you are going to do that? When you do not bring back the money within the stipulated time. If you do not bring back the money within the stipulated time, at that time you are going to do all these things. If you bring back the money within the stipulated time, then there is no need to charge all these things. There is no need to charge any interest, there is no need to charge any tax. But if you do not bring back the money and if the transaction is in INR, then MCLR as on 1st April of the relevant previous year plus 3.25%. Foreign currency if it is transaction, then convert that into INR as per TTBR as on the last day of the year in which the transaction was undertaken. Plus when you convert that, after that you have to apply the rate of interest 6 months LIBOR plus 3% as on 30th September. Okay. And there is one example over here. Sir, while calculating the interest, you also have to consider the period. From when the period will be counted? The period will be counted from the due date of filing of return, and the period will be counted from the date of order. It means the period will be including those 90 days. Including those 90 days, you have to charge the interest. Okay. So here you can see the example. For financial year 22-23, the due date is 30th November. So you have to bring back the money till 20th Feb 2024 because this is the 90 days period which is there. If you do not bring back the money within 90 days, then the period will be, then the interest will be counted from 30th November only. It will not be counted from 20th Feb. It will be counted from 30th November, and from 30th November till 31st March, it comes to 122 days, and interest rate is 8% plus 3.25% of SBI MCLR divided by 366 into 10 crore. Check it please. Okay. Now, till when this will happen? This will happen till the time you don't bring back the money in India. You have to bring back the money in India. Till the time you do not bring back the money in India, this exercise of charging interest and charging tax will go on and on and on and on. So, tell your non-resident associate enterprise, any non-resident associate enterprise to bring back the money in India. Sir, is there any other option? Yes, there is one option which the government is giving. Government is saying pay 18% tax, 12% surcharge, 4% cess, that is 20.9664% tax on excess money once and for all. And once you pay that, after that, on that transaction, we will not charge you any interest. But till that, till the date of payment of this optional tax, we will charge you interest. So, for example, in the next year, in the month of October, you decide to pay this tax. So, from October onwards, you will not be charged with interest. But till September, you will be charged with interest. Whatever tax you have paid in this particular section, you are not going to get any credit of that tax. This is not TDS or advance tax. Further, you are not going to get any deduction of this tax under any provisions of the income tax law. This is not allowed as a deduction. This is not allowed as a credit also, like advance tax and TDS credit which you take. You are not going to get any benefit of this tax. This is a tax which you have to pay and forget about it, so that from henceforth, there will not be any charging of interest. There will not be any charging of secondary adjustment in your income. Check it please. Now, this next provision I will discuss at the end of the chapter. Don't worry, with the help of an example which I have to show you an example. Next one, I am talking about dispute resolution panel. What is a dispute resolution panel? It is nothing but a group of 3 CIT who will do your assessment now. Now, in whose case, who are those lucky assessees and fortunate assessees in whose case dispute resolution panel will be applicable? It is applicable in case of an eligible assessee. Who is an eligible assessee? A foreign company is always an eligible assessee. A non-resident is always an eligible assessee. Is also an eligible assessee. Any other assessee can also be eligible if the TPO has passed an order prejudicial to the assessee. So, in such cases, in case of a foreign company, in case of a non-resident, and in case of any other assessee in whose case the TPO has passed an order prejudicial to the interest of assessee, that is, it has increased the tax liability or it has reduced the refund, it has reduced the losses, then in that case the AO cannot directly pass the order. The AO has to give a draft order to the assessee. After that, the assessee has 30 days. Assessee has 30 days to accept that draft order. If the assessee accepts that draft order, then the AO will pass the final order within 1 month. But if the assessee objects that draft order, then the matter will go to DRP, and then DRP will pass the order. Then the AO has to wait for the directions of the DRP, and DRP will pass the order within 9 months from the end of the month in which the draft order was forwarded to the assessee. So there are two possibilities. You give the draft order to the assessee accepts it. If he accepts, then you close the order. If he does not accept, and if he objects, then what? Then he will go to AO, he will say that I do not accept your draft order, I want to go to DRP, and DRP will pass the direction within 9 months. Okay. And after the DRP pass the direction, then the AO will pass the final order within 1 month from the end of the month in which the directions are received by the AO. Okay. Now, how will the DRP pass the order? How will the DRP issue the direction? DRP will issue the direction by looking at the draft order, by looking at the objection filed by the assessee, evidence furnished by the assessee, report of AO, valuation officer, if officers, draft evidence, etc. All these things will be considered. DRP will give a opportunity of being heard to the assessee and AO, obviously, before passing the order. And if the DRP's direction is binding on AO, it is binding on AO. It is binding on AO. It is not binding on assessee. Assessee can appeal later on against the order of AO to ITAT. So against the order of DRP, you can directly go to ITAT now. You are not going to go to CIT appeal because already 3 CITs have passed the DRP order. So it doesn't make sense to go to CIT appeal. You have to go to ITAT now. Okay. Now in DRP there are 3 CIT. There can be difference in opinion. So if there is a difference in opinion, where to go? Whose view will be considered? 3 out of 2 will be considered. 2 out of 3. 2 out of 3. Whomsoever is following, 2 out of 3 we have to follow that particular CIT's order. Okay. So majority will be considered to be the winner over here in case there is a difference in opinion between the 3 authorities. Okay. Next. This entire proceeding, government has said that now we are going to make it faceless, and the government has extended that will make it faceless by 31st March 2022. Earlier it was 31st March 2024. Earlier it was supposed to be faceless by 31st March 2022, but because of COVID the government was not able to do the things on time, so the government has extended that on 31st March 2024. Okay. Let's move on to the next provision, which is not very important for the examination, but there is one small amendment made by Finance Act 2023. Therefore, it might be slightly important in the exam. 92B is specified domestic transaction. We all know that in some domestic transaction, for some domestic transaction, transfer pricing is applicable if the aggregate value of domestic transaction exceeds 20 crore rupees. Now, remember, for international transfer pricing, there is no threshold, but for domestic transfer pricing, the aggregate value of domestic transaction should exceed 20 crore rupees. Now, what are those aggregate transactions? ATIA, ATIB, ATIAB, ATIAC, ATID, ATI, all profit linked deductions, 10AA, 115BAB. Now, one more section has come, 115BAE, which is in case of cooperative society. Now, what happens in this case? Let me tell you very clearly. These people do what? One entity is eligible for deduction, or one entity is eligible for what? A concessional tax rate, like ATIA, ATIB, 10AA. These people are eligible for 100% deduction in some cases, 50% deduction in some cases, 30% deduction in some cases, and 115BAB, 115BAE, these people are eligible for concessional tax rate, that is 15% tax rate. So they try to manipulate their profits along with their associate enterprise. Okay, so one entity is eligible for this, one entity is not eligible for this. So they try to manipulate, they try to sell at lower price, sell at higher price, buy at higher price, buy at lower price, and try to manipulate the price along with their ineligible unit. So one unit is eligible for deduction, one unit is eligible for concessional tax rate, another unit is not eligible for concession tax rate, and both of them do transaction and try to manipulate profits under the income tax law. So the government says that for you all transfer pricing will be applicable. Okay, how transfer pricing will be applicable? Same way, all the arm's length price provisions will be applicable. 92C will be applicable, the rules of 92C will be applicable, 92CA will be applicable, that is the transfer pricing officer provisions will be applicable, then 92D provisions will be applicable. You have to maintain books of accounts documents, then you have to take the report of chartered accountant. All the penalty provisions will be applicable. Certain benefits which are not applicable for you all are: the benefit of advance pricing agreement is not applicable. Further, the provisions of 92C and 94B, that is secondary adjustment, is not applicable for domestic transfer pricing, and also the limitation of interest provision is not applicable for the domestic transfer pricing. I hope it is clear to all of you. Okay. Okay, now as I have said you earlier that domestic safe harbor rule is applicable for your exam, but international safe harbor rule is not applicable for exam. What is safe harbor? First of all, safe harbor is a circumstance in which if you show a minimum profit to the government will accept your arm's length price. So that is applicable to only certain assessees, not applicable to all kind of assessees. It is only applicable to certain kinds of assessees. So who are the assessees to whom this benefit has been given? A person who has exercised a valid safe harbor option. First of all, you have to exercise the option of safe harbor. Then only safe harbor provisions are applicable. Otherwise, safe harbor provisions are not applicable. It is applicable to whom? It is applicable to government company who are engaged in business of generation, supply, transmission or electricity. So electricity business which are governed by government company, it is applicable to those companies, and it is also applicable to cooperative society who are engaged in procuring, marketing milk and milk products. So it is applicable to these two kinds of assessees: a government company who is engaged in generation, supply, distribution of electricity, or a cooperative society who is engaged in procuring, marketing milk and milk products. Only applicable for these companies. Okay, so as you can see over here, a government company who is engaged in supply of electricity, transmission of electricity, wheeling of electricity, or a cooperative society who is engaged in purchasing of milk or milk products, for them it is applicable. Okay, now what is the safe harbor? How much minimum profit they are supposed to show so that the department will not raise any question? In case of a government company, they have to at least declare the tariff which is determined, or methodology that is determined by the appropriate commission as per the Electricity Act 2003. So in case of government company, how much profit they have to show? They have to show that much tariff which is declared by the Electricity Act. Check it please. Next, cooperative society के केस में purchase of in case of, sorry, I'm really sorry, I am speaking in Hindi. In case of purchase of milk or milk products by cooperative society from its member, the price of the milk or milk products is determined at the rate which is fixed on the basis of the quality of the milk. So based on the quality of the milk, the society decides the price, and that is the price that we have to declare. And if you declare that much price, then that much price will be considered to be what? Your safe harbor, and nobody will raise any question on you. And the said price is irrespective of the quantity of the milk, percentage of shares held by the cooperative society members, and the voting power held by, and such prices are routinely declared by the society and are transparent and available in public domain. So who declared that price? The price which is declared based on the quality of the milk, and it is declared by the society in public domain. Okay, check it please, then we'll go ahead. So let's go ahead with the next one last provision over here, and then we'll move on to that leftover provision which we have left earlier. That this provision is about notified jurisdictional area. If any person in India does any transaction with a person located in NJA, then there are some harsh provision which have been made by the government of India. Now, which territory can be treated as an NJA, notified jurisdictional area? That the government of India will notify. Which territory? But which country? That country with which India does not have effective exchange of information on tax matters. All those countries who do not share information with us on tax matter, India can declare that country as what? As notified jurisdictional area, and an assessee who enter into a transaction with that person, there will be some strict provisions for that. So first thing which we need to identify is what is an NJ? Who can be called as a person located in NJ? A person who is a resident in NJ can be called as a person located in NJ in case of individuals. In case of other than individual, a person who is established in NJ, like a company which is incorporated in NJ, a firm which is incorporated in NJ, LLP which is formed in NJ, can be called as a person located in NJ. Or a foreign company who has what? Any other person who has a permanent establishment in NJ can also be called as a person located in NJ. So if India declares any country as a notified jurisdictional area, and if Indian entity enters into a transaction with those entities, then it is deemed to be associate enterprise. I and that company will be considered to be deemed to be associate enterprise. Second, our transaction will be deemed to be international transaction. All the provisions of transfer pricing shall apply. But that 3% variation which you are having in the case of range concept, that will not be applicable for them. That benefit is also taken from you. All the provisions of transfer pricing shall apply. You have to compute the arm's length price. The transaction is deemed to be international transaction. The persons are deemed to be associate enterprise. Now, if you are making any payment of interest to them, that will be allowed as deduction only if you allow CBDT to take some information from that particular financial institution which is there in NJ. Otherwise, you are not going to get the deduction of interest also. If you want the deduction of expenses and depreciation, if you purchase anything from that particular country, and if you make a payment of expense or if you make a payment for purchase of any asset, that will also be allowed as deduction unless and until, that will not be allowed as deduction unless and until you give the relevant information as asked by CBDT. Further, the deduction will be based on arm's length price. Otherwise, you are not going to get the deduction. So there are so many strict provisions which have been made over here to discourage transactions with notified jurisdictional area. So the government wants to discourage your transactions with NJ. Government is trying to tell you indirectly, don't do transactions with NJ. We are going to discourage that. We will treat that transaction as international. If you make a payment of expense, we will want all the relevant information from that institution. If you make payment of interest, we want details of that particular financial institution. We should be authorized to ask questions to that institution. Next, if you are getting any money from there, from NJ, that money should be explained with a proper source. If you are not able to explain the source of that money, and if the explanation of the source is not satisfactory in the eyes of the assessing officer, it is deemed to be income once again. Can India declare that country as an NJ with which India has DTAA? Yes, India can also declare that country as NJ with which India has DTAA. The condition is not DTAA. The condition is there is no effective exchange of information by that country with India. Then NJ can be declared. Even if a capital receipts is coming, that for that also you need to give the relevant information. And last but not least, this is very important provision over here. If you are making payment to any person located in NJ, you are going to deduct TDS at 30% or the actual rate, whichever is higher. So even if the other person's tax rate is 10%, you are supposed to deduct TDS at the rate of 30% only, or the actual rate, whichever is higher. What if the other person's rate is actually 10%? Tell him to file the ITR. And then he can claim refund of 20% later on. But while deducting the TDS, you have to deduct TDS at 30% only. This is what this provision wants to tell you. Is any country notified as a NJ? Yes, there was only one territory which was notified as NJ, that is Cyprus. That is also removed in 2017 by Government of India. So now, as of now, practically speaking, there is no NJ notified by the Government of India in 2023, sorry to say. Okay. Now coming to this one last provision in the transfer pricing, which is a transfer pricing application along with MAT. What is this transfer pricing provision along with MAT? This is a very dangerous provision. You will not find any example on this anywhere, nowhere, no study material, no author book, nowhere. It's a very dangerous provision. Now, this provision is applicable in case of advance pricing agreement and secondary adjustments along with the provisions of MAT. Now, to explain this provision, I have made one example over here. With the help of that example, I'll be explaining you this provision entirely. Okay. So pay absolute attention now. There are 2 years over here. One is previous year 2021, another is previous year 21-22. Previous year 2021 is past year and previous year 21-22 is the current year. Assume that, okay. Now your past year's book profit is 90 lakhs and your current year's book profit is 95 lakhs, okay. So there are 2 years, one is past year, one is current year. Past year book profit is 90 lakh, current year book profit is 95 lakhs. Now in the past year, you have made an application for advance pricing agreement for 2020-21 and future years. Okay, you can make an application. Okay, and after you make an application for advance pricing agreement, the CBDT will determine the arm's length price, and accordingly your arm's length price will be decided by CBDT. So you made an application and the CBDT signed the application in the next year, and they increase the income by 35 lakh rupees. Okay. Now in the books of accounts, we are not going to change the last year books of accounts. We are going to increase that 35 lakhs in the current year only. So in the current year, we increase the book profit from 95 lakhs to 130 lakhs. Okay. Because books of accounts of last year are closed. We cannot open the books of accounts of last year and close the and change all the things here. We cannot do that. Okay. In case of normal provision, you can change the modified return. Modified return, you can do that. But in books of accounts, you are not going to change the last year's books. So in the current year, you did what? Because the AO increased because the CBDT increased in the advance pricing agreement, the income by 35 lakhs, you increase the current year's income by 35 lakhs. So now the book profit of the current year is now looking at what? 130 lakhs. Now you have to unnecessarily pay on 130 lakhs in the current year. So the government is going to give you some relief. Relief in this form: A minus B minus D minus C. So this much is the relief you are going to get from the current year tax. Okay. Now what is A, what is B, what is C, what is D? This is what it is written over here. So you have to identify what is A, what is B, what is C, what is D. So first of all, what is A? Tax payable by the company on the book profit of the previous year, including past income. So you have to compute the book tax of the company on the book profit of the previous year. Previous year means from the current year, including past income. So it means what? You have to compute first of all A in A. You are supposed to compute in A. Pay attention. Tax on current year profit, including past income. So you are going to compute tax on 130 lakhs now first of all. Okay. So tax on current year income, including past income, is 130 lakhs. This is A. Now what is B? Tax payable by company on the book profit of the previous year. Again current year tax. After reducing the book profit with the past income, now compute tax on only 90 lakhs. So now 130 lakhs minus what? Minus 35 lakhs. Now compute tax only on 90 lakhs. This is A minus B. A minus B is 66, 87, 960. Okay. Now it is not C minus D. It is D minus C. So what is D? Aggregate of tax payable by the company on the book profit of the past years, referred to in item C, after increasing the book profit with the relevant past income. So now you are supposed to compute past year's income, that is 90 lakhs plus past year's profit. So 90 lakhs you will add 35 lakhs, that is past year's profit. You will increase the increased income in the past year's profit. Earlier you are adding the increased income in the current year profit. Now you are going to add the increased income in the past year profit. That will become D, and C will become what? C will become aggregate of tax payable on the book profit of the past year. So whatever is the past year's profit, that will become C. So now this will D minus C. So A minus B minus D minus C comes to 5460, and this is going to be the relief which you are going to get under the income tax law. Okay. So it's very simple. What is A? A is current year profit plus past year income. What is B? B is only current year income. What is D? D is last year profit plus last year profit plus last year income. What is C? C is only last year's profit. Okay. So this is what you are supposed to do, and this is how you are going to compute the relief under this particular section. Okay. So this is what this provision is all about. Just go through it and then we'll move ahead with the next topic, and that is DTAA. Okay. So let's go ahead with the next topic, and that is double taxation avoidance agreement. There are two ways in which the government can give you relief. One is by entering into a DTAA, that is known as bilateral relief. One is without entering into DTAA, that is known as unilateral relief. Now, let's talk about first of all the bilateral relief, section 90. Why a DTAA is entered by the government of India with the government of foreign country and specified territory. There are multiple reasons. First, for granting relief with respect to double tax. If there is double tax, the government will grant you relief. Second, they will give you relief. They will enter into DTAA with foreign country for avoidance of double tax. Indian government does not want to have any kind of double taxation, but at the same time, they don't want to give unnecessary opportunity to the tax evaders. So we don't entertain any kind of tax evasion. We do not entertain any kind of treaty shopping arrangement. All these things are not allowed by the income tax department. This is what the objective is reflected in section 90. Third, we want to exchange information with foreign authorities. Okay. Fourth, we want to recover tax from the foreign countries. Fifth, we want to improve relationship with the foreign countries. We want to improve trade and investments with the foreign country. This is the reason. These are the 5 major reasons why DTAA is entered into by the Indian government with the territory of the foreign country and with the specified territory. Okay. Now, once DTAA is applicable, the provisions which are more beneficial to the assessee shall be applied. It means if the income tax is more beneficial, then apply that. And if the income tax is not beneficial, the treaty is more beneficial, then apply the provisions of treaty that we have seen earlier also in section 115A and other provisions. Okay. That whichever is more beneficial shall be applied to the assessee. Okay. Now, what is the effect of DTAA? Effect of DTAA is that One possibility is that the tax will be charged only in one of the country, either in India or in foreign country. One of the country will take tax, one of the country will exempt tax. The second possibility is that both country will take tax and the resident country will give that deduction of the tax paid in the foreign country. Okay, so if I am an Indian, if I go to UK and earn money, India will also take tax, UK will also take tax, but Indian government will give me some kind of relief from their end. Okay, now one important factor which I have told you earlier also, that DTAA rates, if the tax rate is mentioned in DTAA, they are not further increased by surcharge or health and education cess. They are not increased by surcharge and health and education cess. Be very careful. The DTAA rates are final and conclusive in every sense. They are not increased by surcharge and cess. If DTAA says that royalty is taxable at 10%, then it is 10% only. You should not increase by cess, surcharge. All those things are not relevant in DTAA. Those are relevant in the context of the Income Tax Act 115A, not in relevance of what? DTAA. Next. There is one more section along with section 90. Section 90 and section 90A are almost similar to each other. Both of them are exactly similar to each other. The only difference is in section 90, the Indian government enter into a treaty with the government of foreign territory or with the government of foreign country or specified territory. But here, the Indian government is not entering into a treaty. The Indian government has delegated the process of the entering into treaty to certain specified association, and they will enter into a treaty with certain small associations in the foreign territories. So here the treaty is entered between two associations of two nations, but there the treaty is entered between two countries mainly, or between a country on a specified territory. So here 90A and 90 are almost same only. There is no great difference between the two. Okay. Now, next point, section 90 subsection 3. What does it say? Suppose if there is a particular term which is not defined in DTAA, then how will we define that? If a particular term is not defined, then you have to go to Income Tax Act. And in Income Tax also, if it is not defined, then what to do? If a particular term is neither defined in Income Tax Act nor in the treaty, then what should we do? Then the government of India will bring a notification for the same. The central government will do it by issuing a notification. And what will the effect of that particular definition? Will it be prospective or retrospective? The government said that the effect of the same shall be retrospective and not prospective. It will be from the date on which the agreement was entered and not from the date on which the definition was introduced. Okay. Now next point is about what? About a concept of what? About the concept of treaty shopping activity. Suppose there is a person in India and there is a service provider in Germany. Now, the India DTAA Germany says that royalty is taxable at 30%. But India US DTAA says that royalty is taxable at 5%. So, a German person goes to US and provides services from there, so that he can get the benefit of what? India US DTAA. Will he be allowed to do that? The answer is no. In that case, the Indian Tax Authority will ask for a tax residency certificate from that German. That German will not be able to present the tax residency certificate from US Tax Authority. The US Tax Authority are not going to give him the tax residency certificate, and therefore he has to by default apply the provisions of India and Germany DTAA. He cannot apply the provisions of India and US DTAA just because he is going to US and providing services over there. That is not allowed. So this is what the concept of tax residency certificate is all about. Whenever you have to give a benefit of DTAA to any person, you have to ask the other person to produce the tax residency certificate of that country. Then only we are going to give you the benefit of DTAA. The tax residency certificate should contain which all data? It should contain the name and the status of the assessee, nationality of the assessee, the country or the specified territory where the assessee is registered, unique identification number like PAN number, residential status for tax purpose, period of certificate, address of the applicant. Even Indian government, the certificate will be duly verified by the government outside India and they will issue that certificate to us. In India also, Indian government give what? Tax residency certificate. How Indian government give tax residency certificate? That is also important. Indian government give tax residency certificate to the Indian residents because they also have to present that in what? In foreign country. Yes or no? So suppose if Indian residents wants to take the benefit of India UK DTAA, the UK Tax Authority will also ask for the certificate. So Indian government will give you, the assessee has to make an application in form 10FA and the department will give you the certificate in form 10FB, and accordingly you can show that particular certificate and take the benefit. Okay. Now next provision is extremely important. One of the important criteria of DTAA is that you should not discriminate with anyone. Everybody should be treated properly in a same manner. That is, resident and non-resident should be treated properly. But the government of India says that we will treat non-residents properly, we will treat foreign company properly at par with the residents, at par with the domestic company, but at one place we are not going to treat them at par, and that is the tax rate of the foreign company. If we are charging foreign company 40% and domestic company 25% and 30%, don't say that we are less favorable. We are equally favorable. You have to assume that. This is the provision which is given under explanation to section 90. So there will be a question which can come in the exam which says that the AO is, that the assessee is saying that you are charging foreign company at 40% and domestic assessee is making an argument in front of the department. You are charging the foreign company at 40% and you are charging the domestic company at 25 and 30%. This is discrimination. Tell charging foreign company at 40% and charging domestic company at 25 and 30% tax rate is not considered as a discrimination in the eyes of the law. It is not considered to be less favorable. It is considered to be equally favorable. Don't worry about it. Check it please. Next one, unilateral relief. Very important. One question in the exam generally comes on the unilateral relief. Unilateral relief is applicable when the resident Indian goes to such country with which India does not have a DTAA and there is a double taxation. In that case, the Indian government will give the relief to that particular person. Okay. The conditions are he should be resident in India. Second, the income arises or accrues outside India. Third, the income is not deemed to accrue or arise in India. Fourth, he is subject to tax in the foreign country. Fifth, there is no agreement between India and that country. In that case, what are you supposed to do? You are supposed to include all the incomes. Indian income, foreign income, take chapter 6A, compute tax. Once tax has been arrived, take tax divided by total income, you will get average rate tax rate in India. Okay, keep that aside. Then see what is the average tax rate in foreign country. Compare that with average tax rate in India. Then whichever is lower, select that. Average tax rate in India will be selected, will be compared with the average tax rate in foreign country. Whichever is lower, select that. Once that is selected, then you apply that on doubly taxed income. Whatever is the doubly taxed income, apply whichever is the lower rate. Average tax rate in India or average tax rate in foreign country, whichever is lower, will be applied on the doubly taxed income, and that much will be the relief which will be given under section 91. You have to do that question of Mr. Kamesh from our question bank, which is very, very important question and a very beautiful question. Okay. And one last thing over here in this chapter is circular number 5/2004. I'm just giving you an overview of this particular circular, what exactly this wants to say. This talks about taxability of IT enabled BPO in India. For example, there is a foreign company outside India and it has a IT enabled BPO, business processing outsourcing in India, like call center, service center, etc. in India. Then whether that business process outsourcing in India will be considered to be what? A business connection of that particular non-resident or not. That depends upon the facts and circumstances of every case. Okay. So that is what this particular entire discussion is trying to tell you. Now this entire circular revolves around two things. If that non-resident outside India and the BPO in India are having a business connection, okay, if there is a business connection between the two, then that non-resident will be liable to tax in India. And if there is no business connection between the two, then the non-resident will not be liable to tax in India. And if that non-resident has a business connection in India, that non-resident will be liable to tax in India and his tax will be computed as per the relevant provisions of the income tax law. This is what it is written. Not very important for exam also, you can go through it once. Okay, it revolves around 2 points. If the non-resident has a business connection with the BPO in India, then its income will be liable to tax in India. If the non-resident does not have a business connection with the BPO in India, its income will not be liable to tax in India. Okay, it is as simple as that.